Focus. Ideate. Innovate. Enable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to the Mutual Fund Day Family Financial Plan series. Now, in the previous episode, we saw how investing wisely, but more importantly, early, is the right step to achieve your short-term and long-term financial goals. In this episode, we will feature a case study from Pune and observe how investing at the right time in the right assets has helped transform the lives of the Varde family from Pune. In fact, let's start with observing how the financial planning journey of the Varde family progressed. Let's take a look.
On this episode, we bring you the investment journey of Mr. Amit Varde from Pune, who heads the family business of manufacturing and trading of specialty chemicals for the printing industry. His family includes his parents, wife Aparna Varde and son Atharva. Aparna is a businesswoman trading in industrial cleaning chemicals.
I think I started the investment journey sometime around 2000, 2002. The annual incomes must have been somewhere around 8 to 10 lakhs rupees at that point of time.
Mr. Varde started his investment journey in stocks and shares 15 years ago. A year later, he started investing in mutual funds along with Aparna.
Typically, I didn't know much about the mutual fund market, so it was stocks and shares that I invested in. And then around 2003, 2004, we started investing in the mutual funds. And then around 2008, when there was a downturn again, and there was a need to review the funds that I was holding, I realized that you need to be partnering, or you need to be taking advice from a very sound kind of a advisor.
After 5 years of investing in mutual funds, Amit realized that he needs to get professional advice, and he instantly sought help of a financial advisor.
One of the things that aspires my financial advisor's trust is basically he asks me a lot of questions. He asks me things which I have really not thought about many times. So it's kind of a good sounding board.
With defined short-term and long-term goals, Amit and Aparna look at mutual funds as an instrument to achieve their objectives and grow their wealth.
Short-term goals now, presently, how I look at it is the basic needs which you have, like for the family, as in the medical emergencies and all that should be tackled. And of course, having holiday trips abroad, at least twice, once in 2 years, and maybe locally once in a year.
Like any investor, the primarily goal is to safeguard the capital. The second goal is to ensure that you get return better than bank FDs and whatever you're getting out of the traditional investment options. And the long-term goals are primarily to plan for a retirement with the cost of living going up, inflation, medical issues that will arise with time, and my son's education.
I had setback in my business for some time, so I think past 2008 sometime I started off with my real investment in mutual funds and all. Earlier it used to be FDs in the banks, having that thing like safety was a major concern then. But then as I started off with mutual funds, and especially I felt very promising when I accompanied Amit with this our new advisor. It was something that I felt it is promising to invest in mutual funds.
Alright, that was their journey. We'll take a short break right now, but on the other side, we'll chat with the Varde family, and we'll also be joined by Amit Bibalkar, an independent financial advisor, to understand the nitty-gritties of financial planning. Stay tuned.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series. Now, in the previous segment, we saw the Varde family discussing their financial planning strategies. In this segment, we'll see how their goals have progressed and what's next for their financial planning. And as I mentioned, we're also joined by Amit, an independent financial planner who will help viewers delineate financial planning strategies. Thank you, everyone, for joining us. We'll start with you, Amit. Tell us how you arrived at goals for financial planning.
The primary goal, the big goal, the big picture, is to ensure that your capital is safe. That's point number one. Point number two is, when I started investing around 2002, 2003, didn't know much about the mutual fund industry at all. The options were either keep your money in the bank or put it into the stock market. I tried the stock market. That was not a very nice experience for me, because by that time the bank rates had started coming down. So we put the money into the mutual fund industry. Typically, a person who is not from the financial side or the financial background, doesn't have the financial background, you generally follow what is being told to you by a friend or family friend or an advisor or something like that. And
how was your first experience? How was your first experience with mutual funds?
Well, around 2003, 2004, we did some investments, and the returns were great in the initial part. That was the boom for the mutual fund industry, but the returns were very good. And then there was a downturn around 2008, 2009. At that point of time, when suddenly the NAV started going from 10 to 6 to at times even to 2.
When you got to the planning stage, what were some of the key points you kept in mind?
The key points, as Amit said, is basic safety was a major angle initially, because when the mutual funds were doing really well, there was a great feeling, and when there was a downtime, you do feel jittery, and then first thing you want to do is safeguard whatever you have.
Okay, so in looking at this risk profile, Mr. Bevalkar, a conservative risk profile and a slightly liberal risk profile, how would you rate their financial planning so far?
I think, as I understand, the basic was safety first, then liquidity, and then the returns. So that was pretty straight-jacketed and nothing to do much on the portfolio. So you have your 3-6 month kind of money, you have your 1 to 3 year money, and you have a 5-year plus money. So you had a short-term fund which fitted their profile for that 3-year bucket. You had a liquid fund which fitted their immediate need, 3 to 6 month kind of portfolio. Identifying the core portfolio which had to be stable and which had to be protected at all points of time, and then looking at the satellite portfolio, which actually they can spare for the 5-year, 10-year haul, which they also have their kids' education in mind, they also have their retirement planning in mind. They also, important point what I learned from them was that they are very aware of the medical expenses which are going to rise in future. So we intend to put some money away for that 10-15 year when they intend to retire, and I think that was where equities came into picture. And so I think about 70% debt, 30% equity is what I will classify them as a moderate kind of portfolio, not a pure conservative kind of portfolio.
Right, and Mr. Varde, you've had an interesting journey in mutual funds where it required, the second coming required starting with a clean slate. Would you like to elaborate on that?
Like I said, in 2008, 2009, when there was a downturn and NAV started dropping, and the returns till then were good. They were as high as, sometimes as high as 17-20%. And then suddenly you have the prices coming down. And as a person who is not wanting to deal directly with the stock market on a day-to-day basis, you just put in money wherever you're asked to put in money, right? So you don't understand this sectoral classification and, this is a balance. You just know it when you sign the dotted line, but that's not what you keep in your mind. You keep in your mind what money you have invested in and what kind of a return you would like to have at the end of the day. And when that is not happening, then if your advisor is unable to tell you why it is not happening, or if your advisor is not giving you an alternative route to step out of that kind of a mess, then you feel a little lost. That's the time I was discussing the issue with a friend of mine, and he referred me to Amit. He said, this guy knows the fund industry probably a little better than what you and me know it, so why don't you go and have a discussion with him? And when I took my entire portfolio to him, at that point of time, it was like a patient going to a doctor, right? I'll tell you, it was really like a patient going to a doctor, because you look at the whole thing. He told me it'll take me about 2 days to really understand what we need to do. And on the second or the third day, he called me and he said, I've gone through your entire list of investments and these seem to be okay, but these are, I still remember the words. He said, this is cancer. You'll have to cut this.
For our viewers, they have a world of financial products and a world of financial opportunities present in front of them, and mutual funds are a core part of that. So where do they go about starting to understand where they can invest when it comes to mutual funds?
So when it comes to funds, most of the guys actually Google it, or most of the guys say that आपने लिया है तो सही होगा तो मैं ले लेता हूँ. But it's not that one size fits all. Depending on your risk tolerance, depending on your age, depending on your asset allocation, and depending on the time frame, everything has to be looked, and then I should prescribe something to you. So if you want a real understanding, you have got a lot of websites of mutual fund companies where you can go and find out about what is NAV, what is a mutual fund, what is debt, what is equity, all of that is there. But if you want to really take time out for your own wealth management, I think first of all the discipline has to be there, that you spend 1 hour every month for your own analysis of what you have done. And you should spend 1 hour with your advisor every quarter to understand what is happening on the portfolio.
Right, but purely in terms of the options present, what are the green flags and the red flags?
Mutual funds are actually products which can be an alternative to all of this. So what are the red flags clearly? I should know my risk. I should avoid sector funds. If I have a short-term goal, I should not go in equity. If I have a risk tolerance, I should not be in debt. And the most important thing is, the risk is not investing in mutual funds is the biggest risk. So I'm losing out there because I have got all maturity buckets. I've got all products in every bucket. It's only that which fund is good for me, that you need to depend on your advisor.
All right. So if we could rate the progress of your financial portfolio so far, what are some of the numbers which you think our viewers would be interested in, where you, if I have to assess how you have done over the past few years investing in mutual funds, what are some of the key highlights there?
So we tried to rejig the portfolio in such a way that if they want safety first, then we need to cut out all the equity in that portfolio. And then when we build the portfolio on debt, then we decided that can I put the appreciation in equities. So we maintained the safety net what they wanted, and then we put the appreciation out into equities which have grown to a decent size. So first of all was the expectation management as to what I should expect out of this portfolio. So one was safety, then was liquidity, and then was returns. So if I get a 7% kind of return on a debt fund, I should be happy, which they had mentioned to me that we are okay with a FD plus kind of return. We don't want to venture into unknown territory.
All right, let's take a short break on that note, but lots more insights to discuss on financial planning on the other side of this break. Stay tuned.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series. All right, let's talk about mutual funds as a safety net. Aparna, I believe you had an experience some years ago where the safety net has helped you. Let's hear more about that.
Yeah, a few years back, I had a major setback in my business, and our supplier, he closed down his factory, so I needed some buffer time, to start back. So that was, if I wouldn't be settled on the financial front, it would make me jittery. So I was pretty made comfortable because of my right investments. I was made very comfortable. So it was like that safety factor, which I feel is very important here.
It's interesting that Aparna mentions that, because as you said earlier, that there is that factor of risks in front of every ad. There is a risk disclaimer, but actually mutual funds are much more robust in terms of securing your financial future. What would you say, Mr. Bidal?
So I think more importantly, it is the asset allocation which the mutual fund offers. So you have a combination of debt, equity, you have a combination of balance, you have a US equity portfolio, you have a Central Asia. So whatever you need, I offer all. That's what a mutual fund actually does. So if I need something for a shorter duration, medium duration, long duration, if I need a less risk, high risk, so you have got this riskometer which SEBI has actually printed on every mutual fund fact sheet, also on the form. So I can actually see that, okay, this is risk. So risk comes with return. So you cannot have a risk-free return, which you get in a provident fund account. So mutual funds do give you that return. In equity, you might see some risk. On the long bond side, you might see some risk. But there are products which come on the shorter end, which come with a very minimal volatility and which gives you a stable kind of return. They come with albeit a slight tad of volatility, but I think it offers you a post-tax return which beats everything on the debt side. On the equity side, 1979 you had the Sensex at 100 and today we are at 29,000. So it has given you a 267 or a 289 times return. And then you look at inflation, then you look at gold, then you look at any other asset class. Over such long periods of time, if you compound at 15-16%, I think the corpus grows to a humongous amount. Mutual funds, unless and until you take a plunge, you will not be able to see the experience what you get out of it. So at least one needs to try with a liquid fund, because that's one day money, you can pull out the next day. And then you can't have an experience without actually going into the water.
So you would say have a phased approach when it comes to
graduation
investing.
has to happen from a lower risk product to a higher risk product.
And ideally in a portfolio, what sort of a balance would mutual funds have? For the average viewer, what would you recommend? How much of their portfolio should stock a mutual fund in your opinion?
No, I think since you have all products pertaining to all kind of risks and all kind of investors, I think mutual fund do offer a composite overview balance of the portfolio. So you might want some money to stay in your bank because it's still in the mind. You might have some precious metals if you want to buy, physical. Otherwise you do have gold funds which are available even on the exchange. So you have an alternative to that as well. You might want to have some real estate which you want to still have that house or that farmhouse or whatever you want to do with it. I think financial assets, everything can come to mutual funds.
Okay, and that's interesting because you do not have real estate as a sort of a financial planning goal, but do you see that changing where you say that, okay, maybe we'll have more, two or three more houses, and do you see that changing your financial goals?
I was fortunate that I didn't have to go in for a loan for a house, and secondly is I see a lot of my friends who did that, and then they get into that thing of investing into the other house, the third house, the fourth house, and things of that sort. And if you see, you can only live in one house, right? And the rest you are going to rent out. So if you see the return on rentals vis-a-vis the risks that you have taken, it's not worth it.
All right. Now that you've secured your financial future, what's next in terms of, let's say, retirement planning?
What I see is cost of healthcare is going to go up. One of the main things for me personally is I would like enough to take care of, because whatever life you are going to have, you should have a good quality of life.
All right. So speaking of retirement planning, where do you see the element of mutual funds coming in to help secure retirement planning?
So I think goals have to be timed and they have to be measurable and they have to be converted into amounts. So when we sat down, we decided, okay, you need X amount of money as living expenses right now. Because of inflation, that amount will be so much when you retire. You need a corpus for medical care, so you require so much. You need for Atharva's education and marriage, you need such corpus, you will build that. So every goal, if I link it to funds, typically on retirement, you have got retirement funds now which have been introduced. So you can actually invest into that and you can take a systematic withdrawal from them after the age of 58 or 60 as and when the fund offers. But I think retirement funds are going to be in fashion. So I think retirement funds is now a solution which can be given to a client. So mutual funds now have started offering you solutions like the child care, child benefit, pension plan, you have a retirement plan. I think that fits the bucket very well.
All right. Mr. Varde, any decision, any investment decision that you would have changed now in your long financial journey?
When I started investing about 15 years back, had I consciously gone to a financial advisor and somebody who understands the business well, I think I would have benefited a lot. If that is one decision that I'm allowed to change now, that would be choosing the right financial advisor in 2002 itself.
Amit, Aparna, you've had a successful financial journey so far. What would be your advice to folks at home watching watching your financial story? What would you say to them? Amit?
Choose your financial advisor correctly.
I would say that they have to be very meticulous about their financial strength, increasing the financial strength. They really have to think consciously. Like initially we did not, but when we really understood what it is, well, we know the benefit now. So we feel that, as Amit said, writing down your expenses and planning.
Thank you so much for joining us. It's been wonderful speaking to all of you. And with that, we'll wrap up this episode of the Mutual Fund Day Family Financial Plan series. Another episode comes up next month with another journey of financial planning. Stay tuned. Thanks for joining us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.